It's late. You can't sleep. So you do that thing we all do when the house is quiet and our thoughts are loud. You grab your phone, right? The screen glows in the dark, and you open up your banking app. You're not really looking for anything specific. You just want to see the number. That little bit of proof that you're on the right track, that you're being responsible. And there it is, a nice, solid number. And you can finally breathe. Just a little. It feels good. It feels safe. Like a wall between you and whatever chaos life might decide to throw at you next. On Fair Insight, we usually talk about how money really works. But this part, this little moment at 2 a.m., this is where a huge misunderstanding lives. And it's a part most people completely ignore because that feeling of safety is so comforting, but it's hiding a pretty dangerous truth. So let me ask you a question that might actually be worth losing sleep over. Your money is safe, sure, but is it growing or is it silently, invisibly shrinking every single day? All right, let's get into this. Because that cozy feeling of security from having cash in a savings account, it's mostly an illusion. There's this quiet, invisible force that's constantly working against your money. And that force has a name: inflation. You've heard the word, but what does it actually do? Well, it's the reason a gallon of milk costs more today than it did 10 years ago. It's like a quiet tax that's constantly eating away at the real value of every dollar you've saved. And look at this. This is where it gets really clear. Your savings account might be paying you, maybe 0.5% in interest, but if inflation, the cost of everything, is going up by 2.5%, you're actually losing 2% of your money's power every single year. Your balance goes up a tiny bit, but what you can actually buy with it goes down. And meanwhile, the stock market, on average, has grown by about 10%. That gap, that's the difference between falling behind and getting ahead. The SEC puts it so simply, it's brilliant. Imagine you save $1 today, and it can buy a whole loaf of bread. That feels responsible. But what if, years from now, that same dollar can only buy you half a loaf? Was that really the safe choice? This, right here, this is the hidden risk of playing it too safe. So this brings us to the most important point of all. Saving and investing are not the same thing. Not even close. They're two totally different tools for two totally different jobs. And confusing them is one of the biggest financial mistakes anyone can make. I absolutely love this analogy. Think about it. Saving is like taking your apples and putting them in a cool, dark cellar. You're just trying to preserve them to keep them from going bad for a little while. But they're never going to multiply down there. Investing, though, that's taking the seeds from those apples and planting them. It's about growing whole new orchards for your future. And this chart breaks it all down perfectly. Saving, that's for your short-term goals. An emergency fund, a down payment on a car, stuff you'll need in the next few years. The goal is just preservation. Investing, on the other hand, that's for the long haul, 5 years or more. It's for the big stuff, like retirement. It's where you need your money to actually work for you, to grow into something much, much bigger. So, take a second and be honest. With the money you've set aside for your future, what are you actually doing? Are you storing apples, or are you planting trees? Let me know in the comments. No judgment. I'm just curious. Okay, now for the exciting part. Let's talk about how wealth is really created. It's not about some secret stock tip. It's about using a force that is way more powerful than inflation. This force is called compound interest, or compounding. Einstein supposedly called it the eighth wonder of the world. It's basically your money making babies, and then those babies grow up and have their own babies. It starts slow, almost invisibly, but over time it becomes this unstoppable force of nature. Check this out. Say you invest just $1,000 and it gets a 10% return. After year 1, you've got $1,100. Nice, but not life-changing. But look at year 10. It's over $2,500. The growth is starting to speed up. Now, just let that process keep going for 30 years. That single $1,000 becomes more than $17,000. That's not magic. That's math. That's the mind-blowing power of planting a tree and just giving it time. This is how you build real, lasting financial freedom. Okay, I get it. The numbers are convincing, but the how feels intimidating, right? Complicated? Well, here's the other hidden truth. It's not. The mindset of a successful investor isn't about being a genius. It's about following a very simple, very boring blueprint. The investment giant Vanguard boiled it down to just 4 things. First, know your goals. Why are you even doing this? Second, create balance. Don't put all your eggs in one basket. Third, keep your costs low because fees will eat your returns alive. And fourth, this is the hardest one for everybody, discipline. You have to stay the course even when the market gets rocky and your emotions are screaming at you to sell. And that second one, balance, is so important. It just means spreading your money out. A classic example is something like this: a mix of stocks, which are your growth engine, and bonds, which are more stable, kind of like a shock absorber for the ride. This simple mix helps you manage risk so you can sleep at night. And that brings us all the way back to the beginning, doesn't it? Sitting there in the dark, staring at that safe number on your phone. The fear of losing money, it's a powerful thing. It's what keeps us storing apples instead of planting trees. We are so terrified of seeing our account go down, even temporarily, that we choose an option that guarantees we lose purchasing power over time. And that is the real takeaway here. The biggest risk you face isn't losing some of your money, it's losing your time. It's waking up in 20 years and realizing you missed out on 2 decades of growth, all because you were too scared to start. Look, understanding this difference is one of the most powerful financial realizations you can ever have. If this explainer helped you see things a little more clearly, do me a favor and like it so you can find it again, and make sure you subscribe to Fair Insight so you don't miss the next one. This is Fair Insight. See you in the next video.